Well, good afternoon and welcome to today's FS Club seminar. This is the third that we've done online with our resident expert, Dr. David Doyle, who's an EU financial services policy expert and board member of the Kangaroo Group, part of the EU Parliament. Now, David has given us for many years in FS Club an update on EU financial services regulation every January, and sometimes in other months, but in every January. And we're so delighted that he's kindly agreeing with to continue that tradition with us today. We'll come on to that in just a moment. Now, you'll know me. I'm Michael Mainelli. I'm one of the directors of Zien, and it really is a privilege to be able to do so many of these fantastic webinars. We range widely and freely across technology, economics, and finance, and we can only do so because we have such generous and kind sponsors who are equally intellectually curious. And you can see the names of many of them there. But again, quite naturally, they span technology, economics, and finance. Now, this session today is just a little bit parochial for those of us who are dialing in from the Americas or from Asia. The little issue of Britain's role in the world will feature, but more importantly, the EU, shorn of the UK. As a member of the EU, we are now facing a new world, and we're starting to see some of the dim outlines of that. Well, we're seeing the dim outlines, but David sees the sharp outlines, and he's good at it. So just before we start, I had a quick quiz for everyone, just to get the turn of the audience, and we might ask this at the end, but we're 1 year out from Brexit, and the quiz question today is a fairly straightforward one. Do you think that the effect Brexit has had on UK financial services has been good, has been indifferent, or has been bad? Now, while you're voting, I'll just get the little bits of housekeeping out of the way. Yes, the slides will be posted. Yes, the recording will be up in about 2 working days, so quite probably Friday afternoon. And please do participate in the discussion that we're going to have with David for about 20 minutes after he's made his formal presentation. But to do that, please use the chat room here on the GoToWebinar question and answer facility, because I'm here with you, not on WhatsApp, not on Signal, not on email. Well, here we go. There you go, David. You've got a very Brexit skeptical audience. 60% thinking it's good, 40% thinking it is indifferent, and a slight majority of 53 thinking the effect has been bad. It was a pretty crude question, but I thought it would just help set the tone. So really then, with no more ado, if I may, David, the floor is very much yours.
Thank you, Michael, and good afternoon to each and one of you who are turning out in very big numbers. I'm reassured, so welcome. Well, we started the year in the European Union grappling with supply disruptions, unexpected higher inflation, record government debt, and now, to add to our woes, a fully blown energy crisis in the making as a result of the EU-Russian standoff over Ukraine, which is driving gas prices up by something like 37% alone since the end of November. But on a more optimistic note, the European economies are indeed emerging from COVID lockdowns, and the European Commission has forecast that GDP in the EU and indeed in the Eurozone combined over this year will be around about 4.25%, which is not bad. However, it is becoming very clear in Brussels and Frankfurt circles that corporate debt has reached critical levels. The upshot is that additional debt that was being offered by the ECB and by governments, central banks across Europe throughout the pandemic for very laudable reasons has left many EU corporate sectors very vulnerable to insolvencies, and less likely, of course, to meet the additional hiring and investment ambitions they've set out. Now, the European Union, of course, has also put aside its fiscal rules. The so-called Stability and Growth Pact has put it on ice during the pandemic in order to allow for massive fiscal stimulus. Again, a very laudable measure in itself. But with the economic output now bouncing back, hopefully in a more substantial and sustainable level, we can expect to return to the pre-crisis levels of growth perhaps before the end of this year, pending, of course, no further escalation of problems in the eastern part of Europe vis-a-vis Russia. But the EU fiscal rules are expected to be formally reinstated in 2023, with perhaps some minor adjustments to exclude certain longer-term investment expenditures which have yet to be defined. But the widespread expectation is that Brussels has no plans at the moment to get serious about mounting debt levels. We're not quite out of the crisis yet. And then, of course, there is the inflation dilemma, where the EU appears to be pursuing a distinctly different approach to that of the United States, which has penciled in 3 interest hikes alone this year. Here the ECB has repeatedly stressed, and again earlier this week, that it will stick to its so-called sequencing model. That is to say, they're first bringing the quantitative easing, the massive bond purchasing program to an end before considering any rate hikes, at least this year. Even if the pace of EC asset purchases do decline over the next couple of months, a tightening monetary policy over this year looks very, very unlikely. Now, it is in this challenging context that the EU institutions are taking stock of the regulatory environment as it settles down to a life without the United Kingdom and its all-important financial capital in London. Over the past 2 years, as we'll see from the ensuing presentation, the EU has embarked on a multidimensional approach to regulation that encompasses the cultivation and development of a strategic autonomy approach model aimed at reducing the EU's over-reliance, as it describes it, to non-EU partners, covering everything from pharmaceutical ingredients, especially generic medicines, to semiconductors, and from security to financial services. It's doing this, of course, in a context, as I said earlier, in a background of significant geopolitical and economic distractions, notably the security of gas supplies, where the EU relies for 40% on gas supplies coming from Russia. So, despite the re-emergence of the COVID variant, the tepid revival of any sustainable economic growth, and the departure of the UK from the EU as the host of, and still the host of, Europe's leading financial centre, the EU is forging ahead with some game-changing and very innovative regulatory initiatives. Key drivers here that you'll have heard about, highlighted in the media, include making the EU a carbon neutral region by 2050 and reducing emissions by at least 55% by 2030, not very far away from that, as well as putting digitalization at the heart of all government, corporate and civil society plans. The expectation is that financial services will play a particularly crucial role in all of this going forward. So let's have a look at the key ingredients of these game-changing and innovative, and I would go as far as saying benchmark-setting initiatives that the EU have embarked upon over the last 2 years. And it would be amiss of me not to mention perhaps one of the most important, namely the New Generation Initiative. This was the recovery funding program, which has now been approved by all of the 27 new member states, which will encompass from last year, 2020, until 2027. It's based on the raising of some 750 billion euros, now nearly 800 billion actually, of a recovery fund for the first time in the history of the EU. The EU will act as a capital raising entity, unlike the practice in the past where each individual sovereign state raised its own funding. The important factor here is that these fundings will be allocated to all of the EU member states to help them recover from the mauling of the COVID-19 crisis. Interestingly, a distinct allocation of 37% of this funding will be allocated to climate investments, notably renovation of buildings to provide more energy-saving devices, electrical and hydrogen transport, and also renewable energy type investments. In short, a green investment plan, 37%, a huge amount. And another 20% will be allocated to so-called digital transformation. Everything from developing an EU crowd system to the full digitalization of all aspects of EU financial services, with a digital ID being envisaged very, very soon to enable citizens to at long last start investing across borders, which they haven't been doing to a great level of activity up to now. It should be mentioned also that this 800 billion, if you add the multilateral budget for the traditional seven-year program, we're up to nearly 1.3 trillion euros to be allocated to the EU over the next 6.5 years. Somehow this is of course laudable, it's commendable, but it pales in significance compared to what the US has been capable of doing. It's built back better economic package worth $1.7 trillion, the stimulus bill, a separate one, 1.9 trillion, and the infrastructure package of 1.2 trillion euros. Clearly, this is one of the reasons that has led the EU to, as early as last summer, to start discussions seriously with the EU member states about additional sources of funding. And what is very clearly going to emerge is some form of carbon tax, particularly on imported carbon products, steel, cement being the most prominent amongst these. There's also talk about reviving the financial transaction tax, even if it's at a modest level, and other forms of taxes. There's also talk about reforming and recalibrating the trading emissions system as well for all commodities. So quite visibly, this debate is not over. Extra funding will have to be raised, and it's quite clear that the majority of member states seem to be relatively in favour of raising at least a carbon tax as we go forward. Now, the other big issue on the agenda, strategic autonomy. The Commission early last year, January of last year, issued a paper entitled Strategic Autonomy, where it used words, and I quote, excessive reliance, over-reliance in some cases, on non-EU providers of microchips, defense, generic medicines, but also financial services. On this particular paper, Strategic Autonomy looked at specific areas and measures that could be taken to reduce the over-reliance, as the Commission describes it, on third country or non-EU financial service entities from across the world. A number of areas were looked into, such as the derivatives clearing space, derivatives trading, the fact that many non-EU banks have a lion's share of the dollar FX trading space, etc., etc. And indeed, the Commission is working with the ECB on a range of measures to reduce this over-reliance factor. The other area that has kicked in is the concerns, long-standing, I have to say, even before the Brexit, or even before Brexit indeed, and even before the COVID-19 pandemic, was this notion of how non-EU banks and investment firms manage their clients, their assets, which are based in the EU. Sometimes they operate remotely, and there is a very clear direction of travel here on the part of the ECB and perhaps privately by the European Commission to encourage, at least initially, more non-EU banks, investment firms, to set up a permanent operational basis somewhere in the 27 EU member states, either as a subsidiary or as a branch going forward. And in any event, there will need to be, particularly in the context of AFMD, uses and MiFID provisions, there will have to be at least 2 permanent members from resident in the EU working in some location in the EU on behalf of this third country financial institution, amongst other issues. Of course, back-to-back booking issues are back in the frame as well. In short, we're looking, the EU is looking to ensure that there is a substantive level of presence by third country financial institutions who wish to operate across the EU in various areas, whether it be commercial banking, investment banking, derivatives, or trading and clearing, and related matters. Again, the EU is quietly strengthening its rules vis-a-vis financial services that do business from abroad, remotely in the 27. They need to do so without having to sometimes set up a permanent basis in Europe. Clearly, this physical presence with operational staff as a subsidiary or a branch is going to be a condition sine qua non going forward. Now, let's turn to the 2 innovative, game-changing pieces of innovation here, and I speak of the digital strategy and the various aspects of this huge piece of legislation. Back in 2020, I think it was, September 2020, the EU issued its EU digital strategy. It looked at a range of issues, again, to do 2 things. One, to drive home and accelerate the pace of digitalization across all aspects of financial services, from banks to investments to new forms of investment through remote means on the internet with the normal safeguards, but also to reduce the over-reliance, again, on third country financial institutions. Now, statistic, I think, puts this in perspective. Less than 3% of European Union citizens actually invest across borders. This contrasts usually, of course, with the United States, where people have a single market, they have a single currency, there is a real single financial services market, which we are still struggling to create, despite the laudable attempts of the Capital Markets Union. But clearly, the digitalization move will create the basis for digital IDs, which will enable citizens to be able to cross borders digitally, expand their portfolio of investments with the necessary guarantees and safeguards, and also built-in anti-money laundering measures to ensure that they are acting within the remit of all of the anti-money laundering directives. The other factor that's driving this is the very low proportion of European citizens that actually invest in equities. Whereas in the United States, over 50% of the average US household has at least some equities in the portfolio. This figure drops to 25% on average in the EU, most of it concentrated in the Nordic states, Norway, Sweden, Denmark, etc. And as we move further down the geographical map in Europe, these figures drop quite sizably and significantly to sometimes 10%, like Ireland has only 1% of households that actually hold any equities. This is a problem for the EU. They believe that if the citizens are to boost their non-statutory pensions, they need to start investing now, diversifying their investments across borders, and digitalization is going to help this, particularly if they go towards building up and scaling up their investments in equity financing. And indeed, the ESMA is working on plans to try and make this whole equity space much more interesting. It's very much goes to the core of the Capital Markets Union revisions as we speak, where the Commission is looking not necessarily at replicating traditional bank funding, but ensuring that there's more equity type funding and spreading this to a wider spectrum of investors beyond institutional investors, private equity, pension funds, etc. But probably one of the most important aspects, and there are many aspects, but the one that really has attracted my attention is the markets in crypto assets regulation. Again, a real game changer. Very few other regions in the world, including the US, have gone as far as this. And what this does is to create something similar to MiFID. Indeed, all crypto assets and coins, etc., that don't exist within the MiFID eligible assets category will be now regulated under the markets in crypto assets regulation. The scope includes all asset reference tokens, like the Libra basket coin, backed by a basket of currencies to facilitate global payments. The e-money token, a particularly popular one for dollar-based to US DC and USDTs. The utility tokens like Filecoin, Basic Attention Coin, which give digital access to goods and services going forward. Now, the rules will apply to two distinct categories of players in this market, which are actually, mushrooming as we speak, and don't fall within any particular harmonized regulatory regime. First of all, issuers. They will have to apply for authorization, known as a white paper, 20 days prior to the admission of a national, an emission of their particular asset, crypto asset, to national regulators who can prohibit the token. If they don't, they can go ahead. But specifically for asset reference tokens, they will need specific approval, prior approval going forward. For the asset reference token and the e-money token, direct authorization and supervision will be provided by the EBA and a college of national competent authorities. An unusual move in my view, where up to now the Commission was not prepared to give any of the ASAs any direct supervisory powers, but clearly this is what is emerging. And then the providers, who will be required to have distinct prior approval by the national competent authorities in the jurisdiction where they are launching their range of activities, whether it be custody, brokerage, trading, or investment advice. And from this will be excluded MiFID accredited investment firms. But it doesn't end there. There are some very strict prudential rules. It comes with something like a sort of a mini prudential regime of sorts, where the crypto asset issuer will have to own and maintain capital funds of at least 350,000 euros, or 2% of their total reserve assets, whichever is the largest. And significant issuers will have to increase this market capitalization if the market capitalization is in excess of at least €1 billion, or it can record 500,000 transactions per day of crypto assets. In other words, this will come with maintenance of capital funds equal to at least 3% of the reserve assets that are provided. For the providers, similar prudential rules, initial capital reserves, but in addition, security of the IT infrastructure, and there will be a testing regime brought into place under DORA. There will be checks by the national competent authorities and potentially also eventually by the ECB down the road to ensure that a robust, solid corporate governance structure, independent directors, and last but not least, suitability of the management board, fit and proper rules that are normally applied. So again, a sort of a mini version, a micro version of the Basel III rules applicable to both issuers and providers going forward. Now, this is likely to create a certain number of challenges for existing blockchain and crypto asset providers who already are regulated in Malta, Gibraltar, and Liechtenstein. They'll have to obviously align themselves with this new regulation. There's also talk about aligning the EU regime with the US federal model, where the state banking regulators, for the moment, are more assertive. And clearly, the ECB has already been jumping up and down saying we need action on this quicker than that, by saying, and I quote earlier this year, more exotic market segments such as crypto asset markets will remain subject to speculative bouts of volatility, end of quote. So clearly, there is a need to factor in the financial stability issues that need to be taken into account. And the other piece of important and very controversial legislation in this digital strategy is the EU's Digital Operational Resilience Act for Financial Services. And basically, this means that all critical ICT third providers, including cloud service providers, will be brought under this new regulatory regime, which will consist of imposing a threat-led penetration testing of all these third country party providers. It would also harmonize ICT risk management rules, IC incident classification and reporting rules, all of which would ensure, in short, that any ICT third-party entity associated with financial services firms remains in itself financially resilient and can maintain this resilience through a severe IT operational disruption. Something that I think will go down very well with the ECB, who has been complaining for many, many years, long before Brexit, long before the COVID crisis, that they were concerned about the disaggregated nature of IT systems in many banks across Europe, the fact that there wasn't enough measures taken to prevent and identify and report on issues of crypto instances that occur across Europe. So all of this, sorry?
Yeah, so sorry, yeah, we're just trying to make sure we get enough time for questions, that was all.
Yeah, indeed. So next slide, we need to run through this fairly quickly. Strengthening anti-money laundering. No, this is the other game changer. I think you'll have heard me say in the past many times on these events, one of the least harmonized of any regulatory instrument was the anti-money laundering measures, largely because they're left in the hands of national competent authorities. There was little power in the hands of the EBA, the ECB, or even national competent authorities to police anti-money laundering compliance on a cross-border basis. The Commission decided to bite the bullet. They're going to create a single standalone EU anti-money laundering agency or authority with oversight powers of intervention, of collecting information and also sanctioning powers as well over, at least initially, some of the more important financial institutions. We're talking about maybe 150 financial institutions, banks, fund managers, etc. With an AML policy framework, which will also be drafted to include non-financial entities in the private sector to embrace crypto asset services and crowdfunding platforms in addition. There will also be measures to tighten up on third country, so-called high-risk third country jurisdictions. There is a separate chapter indeed in the European Commission's AML strategy paper, which is well worth a read, and strengthen beneficial ownership rules as well. Completing the Capital Markets Union is something that has dropped quite noticeably from the EU parlance, as it were, obviously because the EU has been more concerned about launching the new generation program of the 800 billion euro recovery plan, but also dealing with the fallout of COVID. But clearly, one of the key issues here is reducing the over-reliance on excessive reliance on non-EU providers, but also a distinct focus away from financial stability towards financing high-growth sectors via non-bank funding vehicles. And here, it's quite clear that the aim is to get institutional investors, private equity, and others to start making their voice heard in this particular space. The emphasis will be placed on raising funding through equities rather than debt, and indeed the Commission are looking at ways of making this perhaps more attractive to the financial services sector as a whole. It's important to note here that as of last year, in terms of GDP, the EU financial services sector as a share of total GDP was less than half of that of the United Kingdom. The United Kingdom, in short, still represents a huge part of the EU share of financial services. To give you an example, London, in terms of the share of EU business and transactions, 84% of derivatives trading, 90% of derivatives clearing, 82% of foreign exchange, and 42% of all assets under management. So quite clearly, and even Commissioner Dombrovskis, the person who oversees the whole financial services agenda, was to comment late last year, and I quote, "Developing deeper capital markets across the 27 EU member states is neither easy nor quick to do," end of quote. That says it all. But quite visibly, some emphasis will have to be put on this. And the good news, of course, is that this could be done in tandem, hand in hand with the United Kingdom. We've seen already some very constructive moves by the European Commissioner a couple of weeks ago, who announced that there will be an extension to the temporary derivatives clearing equivalency arrangement, which was due to come to an end at the end of June 2022 this year, whereby UK CCPs, clearinghouses, can continue to clear derivatives, FX, swaps, and so on from the bases in London on behalf of the 27 EU member stakeholders. So some good news there. Clearly, there's an awful lot more to be done. And there is, I think, an explicit recognition that this cannot be done alone by the EU. There has to be some degree of cooperation and dialogue, which is sadly missing at the moment. We haven't even got a signed up copy to the MOU on regulatory dialogue that was supposed to come into place in March of this year.
That might be a good time on dialogue, just to kind of pause and try and get some of the questions in here. And got about 10 minutes, so we may have to be quite short and sharp on a couple of these. A quick question from Liz Thrussell. Is this ICT digital strategy, part of DORA, the Digital Operational Resilience Act?
Yes, it is.
Okay.
Yeah.
Hugh, kind of curious, exactly when might the new crypto regulations become effective?
We're looking at the earliest date is 2024. It could be earlier. It's gone remarkably smoothly through discussions of the European Parliament and the Council. I was surprised. I don't think we're going to expect the same degree of efficiency when it comes to negotiating the finalization of the Basel III package, but it could be earlier. But earliest, I would say January 2024.
Malta has traditionally had a habit of complying with EU regulation as quickly as possible. It's almost been a selling point to people locating in that jurisdiction. Do you see them doing the same thing in crypto, or are they a bit too far out there? Because they've been also deep in crypto for a while. So it's almost back.
Yeah, look, as I said earlier, it's not just Malta. It's also Liechtenstein, Luxembourg, and indeed Germany. They are going to have to, over time, align their national crypto asset regimes with the EU package. They'll be given, a transition period in which to do that. So this will not be a big bang, but quite visibly, the Commission is determined to have one single regime, harmonized rules, and not individual sovereign states taking individual initiatives.
Okay. Dan Feeney, will EMIs and payment institutions be more severely regulated for more stringent compliance and risk? Dan believes Wirecard really should have been a wake-up call, that collapse in Germany.
Yeah, absolutely. And indeed, the ECB will be acquiring some new powers in this space, not immediately, but very soon. It's already acquired powers over systemic important investment firms since June of last year, third country CCPs, third country benchmark administrators, and yes, EU payment entities of over a certain size potentially will be brought under the remit of the ECB. There are still, I think, terms of reference that need to be worked out between the EU, the Commission, and the ECB in terms of this going forward. But the answer is a resounding yes, particularly as it dovetails a lot of what I mentioned under the digital strategy, which is to create a digitalized payment space, which is safe, which is devoid of any money laundering risks, and which is simple and friendly to use. So clearly that will have to, the payment institutions and entities will have to be brought under some form of regulatory framework.
Okay. Martin Watkins is curious, could David comment on the probability of MiFID II embracing securities tokens by, say, this summer?
Well, the answer is probably no, because the crypto tokens are actually part of this new crypto assets regulation. In other words, everything that doesn't fall under MiFID II as eligible assets, and that has been expanded quite extensively in the last couple of years, will be brought under a separate remit under the crypto asset regulation. With either as an issuer or as a provider, with the rules that I've just mentioned, which are fairly intrusive in terms of capital requirements, in terms of governance arrangements, fit and proper rules governing the managers, etc. So it's a different regime to that of the MiFID.
Okay. Anita Miller, progress on banking union and by extension the capital markets union needs to be underpinned by a common deposit or insurance regime and corporate solvency regime. Any news on either of those two fronts?
No. I think the EU has pretty much put this on the back burner after 5 years of trying to thrash out of an agreement. There is still this dichotomy, divergence of views between the northern European countries and the southern European countries. That doesn't seem to be at all bridged, even during the last discussions. So I guess that will probably not be a priority going forward. There are more important things happening, such as the crypto asset space, such as the DeFi, the decentralized finance area, which represent much more important financial stability risks than the deposit guarantee scheme at bank level.
Hugh Purser, again, strategic autonomy. Does the non-EU really mean London, or is the target genuinely global?
He's referring to the EU here. Well, I think the answer is blatantly, for me, it's blatantly obvious, even if it's not expressed in those terms. The statistics I quoted earlier, 84% of derivatives trading, 90% of derivatives clearing, 84% of FX trades, the bulk of IPOs that continue to take place in London on behalf of the rest of Europe, I think are testimony to the fact that, yes, the EU continues to need and to rely on London City, given its ecosystem, which it's built up over many years. And there's a couple of other factors that are contributing to this. One, as we discovered over the last couple of months in trying to, with the regulators like the EU and the ECB, trying to encourage and even force a relocation of derivatives clearing to one of the 27 EU member states, particularly in those that are euro denominated. I think it's probably failed simply because the institutional capacity on mainland Europe and the liquidity factors don't exist at the moment. It'll take many, many years to build these up. So yes, I think the EU will continue to rely on London. Again, my personal view is that it's a pity that this is not happening in the context of collegial exchanges of views under the auspices of this MOU on regulatory dialogue, which would, I think, have provided a basis, as it does, incidentally, for EU and the US going back at least a decade. It would have provided a basis for some sensible compromises going forward.
Okay. Got a lot of questions here, and I also want to just quickly run that poll in the 3 minutes available. But just very quickly, Andrew John Mills had a point very early on, and I held it a bit. And to some degree, I think it's because we had Anu Bradford on from Columbia last year on the Brussels effect. And if you could keep it short, but whatever one's view of the EU's regulatory philosophy, would David agree that by putting themselves at the cutting edge of interventionism, they are effectively setting the agenda for regulation across much of the non-Chinese world? And if so, what are the implications for other regulatory spheres, US NAFTA, UK, Switzerland, EEA? Is the EU really driving the regulation from here on, in your opinion?
Yeah. Certainly where we stand today in terms of the digital, the sustainable finance agenda, they are driving, and of course the AML strategy as well. They are very definitely setting an international benchmark, which means that non-EU regions like China and elsewhere don't necessarily have to follow this, but if they want to operate optimally in any one EU member state or across the 27 EU member states, they will need to apply these rules.
Okay.
There will be no exceptions.
Well, we got a lot of comments. Leave a Lowit on, whether or not the SAI review is a non-critical piece of financial services legislation. Dan Feeney again would love to chat more about the importance of the digital identity framework. Are we getting closer to something like Estonia? Martin Watkins again on the microcredit assets, crypto asset stuff. Abel Abo on the Abel Abo on the EU AI strategy. And Ian Sheridan looking at kind of also the influence of all this on WIPO. So a lot of discussion we could have. But what I'm going to do, if you don't mind, is I'm asking Peter to just launch that poll there. And while it's being answered, David, would you mind? There you are in Paris. You're in the heart of the scene, and when you're not having a wonderful lunch, what's the Parisian view of Brexit and its effect on UK financial services?
Well, we're still in a period of acrimony, as you would normally associate with any divorce. It was a very acrimonious divorce. There was a sense in France, shared in other capitals in Europe, that the United Kingdom had abandoned the EU, that it was perhaps an unreliable partner, fickle, etc., etc. So there still is this, sadly, this lingering perception. But you know, this has dissipated, particularly in the last 18 months. Right. You know, you don't see much about this when you read Le Figaro or Le Monde any day. What you're looking at is how are we going to deal with running up to the elections this April, which are poised to be very controversial. Issues like immigration, issues like dealing with COVID, strategic autonomy vis-a-vis the French frontiers. They're the issues that are most pressing for the French electorate.
I think you've done something really good, David. You can see here that you've moved about 7% of the group. I think it's a good effect, and I think anybody listening to the fact that we're out of some of the things that you were chatting about, I think has left. Maybe we are better off a little bit away from all that. David, it is always a delight to have you. You've got so much content, and we really appreciate you sharing it with us. Loads of questions here. They will all be sent to you with emails attached, so you can answer them if you wish. But sadly, at this point, I have to say goodbye. I will get out our now traditional non-EU audience thank you note and say, Clapper, thanks you. And we hope to have you back, and not next January, hopefully sometime before that as well. Thank you so much.
Thank you.
Bye.
Thank you.